Will November's historic market rally hold true this year? Is the German economy on the brink of recession as Volkswagen plans to close 3 factories? And what's driving volatility in oil? Welcome to the Daily Show, where we take a look at the latest economic news, market data, and stock market updates. It's a packed week for big tech earnings, so stay tuned for all the key insights. Volkswagen is gearing up for a major shakeup, with plans to close at least 3 factories in Germany and potentially lay off tens of thousands of workers. This comes as the German auto giant battles rising costs and struggles to stay competitive in the electric vehicle market. Daniela Cavallo, head of VW's Works Council, addressed employees at the Wolfsburg plant, warning that this wasn't saber-rattling in the collective bargaining round but a serious push to restructure the company from within. According to VW brand chief Thomas Schaefer, quote, "We are not earning enough money with our cars currently," end quote. With costs for energy, materials, and personnel rising, VW says some of its German factories operate up to twice as expensively as competitors. Schaefer added that they cannot continue as before, stressing the need for a sustainable solution to the company's mounting challenges. The potential closures and layoffs have put intense pressure on Germany's government, with unions calling for a master plan to protect jobs. Berlin acknowledges VW's tough position, emphasizing that past management mistakes shouldn't fall solely on employees. This comes in a year of economic stagnation in Germany. However, Cavallo has warned executives to reconsider their proposals or risk strikes. VW's latest cost-cutting strategies will be revealed on Wednesday with the release of third-quarter results, adding more tension to the ongoing standoff between management and labor. On the Asian markets, the Japanese yen is feeling the pressure, hitting a 3-month low against the US dollar following election losses by Japan's ruling coalition. The dollar surged to a high of 153.88 yen, as political uncertainty in Japan added to concerns over monetary policy. Adam Button, chief currency analyst at Forex Live, pointed out that, quote, "A surprise election result has added to this uncertainty around monetary policy," end quote. With Japan's central bank expected to hold rates steady, the yen may continue facing challenges as the political landscape remains unsettled. JP Morgan CEO Jamie Dimon isn't holding back in his criticism of U.S. financial regulations. Speaking at a conference, Dimon said it was time to fight back against rules he says hurt both banks and lower-paid individuals. He argued that overlapping regulations on capital requirements and open banking are stifling efficiency. Known for his outspoken views, Dimon's stance resonates in a regulatory landscape under intense scrutiny. Let's continue with the macro and market data segment. November is historically a strong month for the markets, especially for the S&P 500, and this trend often extends through the next 6 months. Looking back, November, December, and January have consistently delivered some of the best returns for the S&P since 1950, with an average of 4.4% in November alone. The last time the S&P 500 fell more than 1% in November was in 2008. November has been the best month in an election year and in the past 10 years, and the second best month in the past 20 years, only trailing July. In fact, we are entering the best 6 months of the year for stocks. Since 1950, the November to April period has had an average return of 7.1%, with a 77% probability of being positive. The sell in May period is near its end, and this year, the S&P 500 has gained over 15%. When the May to October period sees an increase of more than 10%, it typically bodes well for the next 6 months, with an average return of 13.2%. Additionally, the first 10 sessions of November during presidential election years have reported an average return of a little over 1% and a median return of 1.36%. Making it the second-best 2 weeks of the year for stocks. On the political front, the implied move for the upcoming U.S. election has eased, dropping to just 2%, possibly due to Trump's improved standing in the polls. However, the bond market will be busy over the next 9 days with key events, including employment data, PCE inflation numbers, and the Fed's interest rate decision on November 7th. These events could impact yields, adding a bit of uncertainty as investors navigate economic indicators amid the election. Shifting to consumer spending, there's good news for Americans. Food expenditures in the U.S. have finally normalized to pre-pandemic levels, reversing the extreme inflation we saw, especially in food. This provides some relief for households and a potential boost to consumer spending in other areas. Lastly, in China, data suggests fiscal stimulus has had a much stronger impact on equity returns than monetary measures over the last 15 years. This is especially relevant as China rolls out a new fiscal package aimed at reigniting economic growth, which has been struggling recently. If history repeats, this fiscal boost might provide the momentum Chinese markets need to rebound. Wall Street started the week on a positive note, with all major indexes closing higher on Monday. The Dow led the gains, up 0.65% to reach 42,387 points, while the S&P 500 and Nasdaq each gained nearly 0.3%. Investors seem optimistic as we head into a packed week of big tech earnings, including updates from giants like Alphabet, Meta, and Apple. Meanwhile, the Russell 2000 Small Cap Index jumped an impressive 1.63%, as small caps are catching up to the growth seen in the major indices over the past few months. Treasury yields, however, tell a different story. The 10-year yield remains elevated at around 4.27%, a 3-month high, reflecting cautious sentiment in the bond market as investors anticipate upcoming economic data and possible impacts from the U.S. election. With the S&P hovering near all-time highs and small caps showing strength, investors are keeping a close watch on whether this week's economic data and earnings can sustain the rally. The Fear and Greed Index currently sits at 62. That's a slight increase from the previous close at 61, though down from a week ago when it hit 67. Once again, markets are cautiously optimistic, waiting for the big earnings reports and economic data scheduled for this week. In the past session, we saw notable gains in sectors like clean energy, up nearly 4%, and regional banks, climbing around 2.9%. Metals and mining also performed well, rising 2.55%. On the other hand, utilities and energy lagged, with gold miners down around 0.5% and semiconductors sliding by 0.7%. Monday's rotation was mixed, but defensive plays mainly lost traction. Crude oil took a substantial hit yesterday, plummeting over 6% after Israel's recent retaliatory strikes on Iran-targeted military installations but steered clear of critical oil and nuclear infrastructure. This targeted approach eased concerns of a wider conflict impacting oil supplies, pushing Brent down to $71.42 and WTI to $67.38, both marking their lowest levels since early October. Today, oil prices have ticked up around 0.5% as markets digest the news, but they remain well below previous highs. Meanwhile, natural gas has been highly volatile, experiencing a sharp 10% drop yesterday before rebounding with an astonishing 23% gain today at the time of this recording. Gold remained stable yesterday but is trading up over 0.3% today. The precious metal continues to serve as a safe haven asset amid ongoing Middle Eastern tensions, with investors keeping a close watch for any signs of escalation. As we mentioned yesterday, this week is packed with high-impact earnings and economic data. Today, Alphabet and AMD kick off big tech earnings, while Microsoft and Meta report on Wednesday. The biggest market moves are expected on Friday, the day after Apple and Amazon release their earnings. On the economic front, today brings the JOLTS job openings and consumer confidence data at 10 a.m. Eastern Time. More importantly, keep an eye on Wednesday's GDP report and Thursday's PCE inflation data, both crucial as the Fed evaluates potential rate changes. Please subscribe and hit the notification bell to stay tuned for daily updates. If you've made it this far, thank you, and see you tomorrow.